Imagine tomorrow morning, you wake up, grab your phone to pay for coffee, and your money app shows 0. Your cards don't work. ATMs are empty. The only way to get breakfast is to trade something you own face to face. No dollars, no cards, no Bitcoin. Just you, your stuff, and other people. That world is not science fiction. For most of human history, that was normal. And the crazy part? The same forces that pushed us from simple trade all the way to Bitcoin are still at work right now, shaping what your money will look like in the next 10, 20, 50 years. In this video on Economy Reboot, we're going to take a full journey from barter to metal coins, to paper cash, to the US dollar, to digital payments, and finally to Bitcoin and beyond. By the end, you'll see money as a story humanity keeps rewriting. And where that story might go next will probably surprise you. Before we dive in, if you're interested in how money, the dollar, and the global economy really work behind the scenes, hit that subscribe button to join Economy Reboot. We break down big ideas in simple language without hype, so you can actually understand the system you live in. Let's roll back thousands of years. There were no banks, no credit scores, no tax returns. People lived in small communities. If you were a farmer with extra grain and you needed shoes, you'd find the local shoemaker and trade. This is barter. I give you something, you give me something. Simple until it isn't. Imagine you sell eggs and you want meat. You go to the butcher. But today, the butcher doesn't want eggs. He wants grain. So now you have to find someone with grain who wants eggs and then trade that grain for meat. Economists call this the double coincidence of wants. Both sides have to want what the other has at the same time. That makes bigger trade and bigger societies extremely hard. So slowly, people start using certain special items that almost everyone is willing to accept. Things like salt, shells, beads, cattle, pieces of metal. They're not just random, they tend to be durable, hard to fake, and widely valued. Over time, these items start to act like early money. You might still trade directly sometimes, but this special stuff becomes the thing you can always fall back on when direct barter fails. Now picture ancient marketplaces in places that are now Turkey, Greece, or the Middle East. As trade grows, kings and city-states realize they can standardize this special stuff. Instead of random pieces of metal, they issue stamped metal coins. Each coin has a symbol or face on it showing weight and purity, guaranteed by the ruler. One of the earliest known coin systems came from a kingdom called Lydia around 600 BC. Once coins exist, life changes. It's much easier to tax people. It's easier to pay soldiers. Long-distance trade explodes because everybody trusts these little metal discs more than random lumps of metal. Money is no longer just stuff. It's a shared belief. You accept the coin not because you really need metal that second, but because you know everyone else will accept it later. That idea, money as a shared story, is still the core of our system today. Coins worked well. But as trade got bigger and more complex, carrying a lot of metal around became dangerous and impractical. Imagine trying to move a chest of gold across continents. In some parts of the world, especially in China during the Song dynasty, merchants started using paper notes, basically written promises that you could redeem for metal later. These were the ancestors of paper money. In medieval and early modern Europe, a similar thing happened in a different way. People deposited gold with goldsmiths or early bankers and got receipts. Those receipts started to circulate. Instead of going back to the vault, people just exchanged the paper claims. Eventually, governments stepped in and turned these private notes into official banknotes. For a long time, those notes were tied to gold. You could, in principle, walk into a bank and redeem paper for a certain amount of gold or silver. This is the idea of the gold standard. Fast forward to the 19th and early 20th century. Many major economies, including the United States, operated on some form of gold standard. Each dollar was defined as a specific amount of gold. That gave people confidence. The currency was backed by something tangible, but it also limited governments. They couldn't just create money whenever they wanted. They were tied to how much gold they held. Then came the 20th century, with world wars and economic crises. After World War II, the US held a huge share of the world's gold reserves. In 1944, an agreement known as Bretton Woods created a system where many countries pegged their currencies to the US dollar, and the dollar was pegged to gold. So if you held dollars, in theory, you held a claim on US gold. But as decades passed, the US spent heavily, especially on things like the Vietnam War and domestic programs. More and more dollars were created, and other countries started to wonder, are there more dollars out there than the gold to back them? Some foreign governments began demanding gold in exchange for their dollars. The pressure on US gold reserves grew. In 1971, President Richard Nixon ended the direct convertibility of the dollar to gold. From that moment, the US dollar became what's called fiat money. Fiat is a Latin word that basically means let it be done, or bank, or by decree. In simple terms, money by government order. A dollar was no longer a claim on a fixed amount of gold. It was just a dollar because the US government said so and because people continued to accept it. Today, most of the world's currencies are fiat currencies. The value of a US dollar doesn't come from metal, it comes from confidence. In the US government, in the Federal Reserve, in the strength and size of the US economy, and in the fact that other people and businesses here and around the world will accept those dollars, fiat money gave governments and central banks more flexibility. In the US spheres, the Federal Reserve, created in 1913, can adjust interest rates and influence how much money flows through the economy. In bad times, it can lower rates and make borrowing cheaper. In a crisis, it can provide emergency liquidity. That flexibility helped the US respond to events like the 2008 financial crisis and the 2020 pandemic. But there's a trade-off. When creating money becomes easier, the risk of inflation rises. Inflation is when prices go up over time and each dollar buys you less. A little inflation is normal in our system, but too much for too long can erode savings and income. So modern money is a balancing act, stability versus flexibility. While all of this was happening, another quiet revolution started. Money became more and more digital. In the mid-20th century, credit cards appeared. At first, they were literally pieces of paper or metal plates used at specific stores or gas stations. By the 1950s and 60s, companies like Diners Club and later Visa and MasterCard turned credit cards into a mass phenomenon in the United States. Instead of carrying a lot of cash, you could swipe a piece of plastic and pay later. Debit cards, ATMs, and electronic bank transfers followed. By the 1990s and 2000s, the internet turned your bank into a website. You could pay bills online, shop online, and send money without touching cash. Apps like PayPal made it easy to move money around the web. More recently, services like Venmo, Cash App, Zelle, and Apple Pay have made digital payments a daily habit in the US. Buying something with your phone or watch is now normal. Many of us barely touch cash in our everyday lives. Think about what that means. Even though we still talk about dollars, in practice, a lot of those dollars only exist as numbers in databases. When you look at your bank balance on your phone, you're looking at entries on a server somewhere. Every tap, every swipe is just messages between computers, moving numbers from one account to another. At this point, you might be thinking, if our money is already mostly digital, what makes something like Bitcoin different? To answer that, we have to go back to another key moment, the 2008 global financial crisis. In 2008, big financial institutions failed or came close to failing. Governments and central banks stepped in with massive bailouts and emergency actions. Many people felt the system was fragile and unfair, that it relied too much on trust in big banks and central authorities. In October 2008, right in the middle of that turmoil, a person or group using the name Satoshi Nakamoto published a white paper describing a new kind of digital money, Bitcoin. Bitcoin launched in January 2009. The core idea was radical, a form of digital money that doesn't rely on any single bank, company, or government. Instead of a central ledger at a bank, Bitcoin transactions are recorded on a public ledger called the blockchain, maintained by a network of computers all over the world. No one can just log in and change the numbers. New Bitcoins are created at a predictable rate, and there is a hard limit coded in 21 million Bitcoins ever. To some people, especially those who worry about inflation or don't trust central banks, this was extremely attractive. A digital asset, limited in supply, not controlled by any government. Over time, other cryptocurrencies followed with different designs and goals. But it's important to be clear and honest here. Cryptocurrencies are very volatile. Their prices can rise dramatically and fall just as dramatically. They've been used in innovation, but also in scams and speculative bubbles. Different countries, including the US, are still figuring out how to regulate them. Nothing in this video is financial advice. The goal here is to explain how the story of money evolved, not to tell you what to buy. While some people experimented with Bitcoin and other crypto, central banks around the world noticed two things. One, that people were clearly interested in digital money, and two, that the existing payment systems, especially across borders, could be slow and costly. This led to another idea, central bank digital currencies, or CBDCs. A CBDC is basically a digital form of a country's official money, issued directly or indirectly by its central bank. Unlike Bitcoin, a CBDC would be centralized. The central bank, not a decentralized network, would control it. Some countries are already testing or using versions of this. The United States hasn't launched a digital dollar, but the idea has been discussed and studied. In theory, a digital dollar could make some payments faster and cheaper. It might make it easier to send government aid directly to citizens in a crisis, but it also raises big questions. How would privacy work? How much could the government see? How programmable would this money be? Could it be restricted or targeted in specific ways? Those are debates that are still unfolding. Throughout all these changes, from barter to coins to paper to digital, one ancient form of money has never fully gone away: gold. For thousands of years, gold has been used as a store of value and a symbol of wealth. Even today, central banks, including the U.S. Federal Reserve through the U.S. Treasury's holdings, keep large gold reserves. Investors often look to gold as a safe haven during periods of uncertainty. So even in a world of apps and blockchains, this old metal still plays a role in the financial system. If you zoom out, a pattern appears. Humanity keeps redesigning money to solve the problems of the last version. Barter was simple but inefficient, so we got early forms of money. Metal coins made trade easier, but were heavy and hard to move, so we got paper claims. Paper claims tied to gold limited inflation, but made it hard to respond to big shocks, so we got fiat money. Fiat money gave flexibility, but created distrust about printing and inflation, so we got alternatives like Bitcoin. Digital payments made life convenient, but raised questions about privacy and control, so we're now debating things like CBDCs and the future of cash. The big question is, where is this going, especially for people living in the US? One possible future is a world where physical cash becomes rare. You use your phone, your watch, maybe even your car or fridge to pay for almost everything. Your paycheck goes straight into a digital wallet. Bills, subscriptions, rent, all automated. For many younger Americans, this already feels close to reality. Another possibility is that we see a mix: government-backed digital dollars, private payment apps, and decentralized cryptocurrencies all coexisting. You might use official dollars for your job and taxes, stable digital coins for everyday spending, and maybe hold some alternative assets like crypto or gold as a kind of digital or physical savings. How that mix looks will depend on technology, regulation, and what people actually trust. There's also the question of control. Digital money can be incredibly convenient, but it can also be tracked more easily. That raises real issues about privacy and freedom. In the US, debates around how much financial data governments and companies should see are already intense. As money becomes more digital and more programmable, those debates will only grow. And then there's AI. We may be heading toward a world where a lot of your financial life is managed by algorithms. Systems that automatically adjust your budget, pay your bills, invest small amounts, or even negotiate prices on your behalf. That could be helpful, but it also means your relationship with money might become more abstract. Instead of handing over cash or even tapping your card, you might just set rules and let software handle the rest. So from a guy trading goats for grain, to you tapping your phone at Starbucks, to someone in the future whose AI assistant automatically buys their groceries with a digital currency, you're all part of the same story. Money is just how we keep score of value and move it around. The forms change, the technology changes, the power structures behind it change, but the human need to trade, to save, to plan for the future stays the same. If you've watched this far, your perspective on money is already different from most people. You now know that today, US dollars are just one chapter in a very long book that includes shells, coins, gold, paper digits, and now code. I'd love to hear your thoughts. If you had to choose, would you rather live in a world with only physical cash or a world with only digital money? Tell me in the comments which one you'd pick and why. I'm going to be reading and replying to as many as I can. And if you found this journey from barter to Bitcoin interesting, please hit the like button so more people can discover it. Share this video with a friend who still thinks money has always been like this. It might blow their mind to see how much has changed and how much could still change in their lifetime. For more deep dives into how the economy really works, from the power of the US dollar to the role of oil, gold, and technology, make sure you subscribe to Economy Reboot and turn on notifications. This video was just the beginning. In upcoming episodes, we'll break down how the dollar became the world's reserve currency and what could actually challenge it in the future. Thanks for watching, take care of yourself, and remember, money is a tool, not a goal. Learn how it works, and you'll be better prepared for whatever the next chapter looks like.